In this session we want to talk about the evaluation of segments and targeting strategies. It's a short session, so it won't take us very long to get through this one. Nonetheless, stop the video from time to time, make your own notes and make sure you research the points and have a good set of notes at the end. Start with market segment. So for the company, identify its market segments. That is the first part. So the company must identify its market segments. It must analyze the segments and then decide on the targeting process. Now, this gives an insight into the segment's attractiveness. So the company must first of all identify the segment, then analyze it, and then decide on its approach to the segment, how it's going to deal with that segment. Now, the size of segment, well, there must be a realistic assessment of the segment size. It's wrong to be overly optimistic or indeed pessimistic. So it must be realistic, and it must be based ideally on some research or some insight, ideally some objective research. In other words, there should be sufficient customers for a segment, for it to be in a segment, for it to be effective. So it's almost pointless targeting a segment if there is not enough demand within the segment for the product. So that's a consideration. Also, the growth rate of the segment is important. Identifying existing customer demands and using current trends to forecast to future customer demands. So it may be possible to look at existing customer demands and try to project from that what's the likely future state of the market and thereby assess future growth prospects. But ideally, the market segment should be capable of growth. It certainly should be capable of sustaining a new market entrant. So if it doesn't, it is pointless targeting it. If the market is already saturated, then it may be that it's not an attractive proposition from the start. So there must be room in the market to enter, and there must be some evidence of possible growth of the market or potential for growth in the market. So a potential entrant into the segment should look at the competition in the segment. The competition affects the level of attractiveness and profitability of the segment. If there are many companies already there selling in that segment, it may be a crowded marketplace, so that markups are being reduced, and it's not very attractive. So the market segments can easily become unattractive due to new entrants, and there could also be a great deal of competitive rivalry, both in terms of marketing effort, and it could be based on even price. Also based on location, based on the product itself. Perhaps the changes in the product have to be introduced rapidly to maintain customer interest in the product. And there's a need for strategies to overcome any of the competitive rivalry. If a company is thinking of entering a segment that already contains some competition, it must have a set of strategies worked out to cope with that competition. It must be able to deal with the competition and outcompete it. The market segment should have sales potential and profitability. It's not just a question of entering the segment and selling in the segment. It must be selling at a profit. That's the whole idea. So it's important not to lose track of the overall purpose. So it's necessary to look at the overall customer demands and see whether these are being met. If they're not being met, then perhaps there is a niche, but they have to be met with a markup to enable the business to make a profit. And larger segments are not always very profitable due to competitive pressure. Larger segments attract more companies, more businesses, because they want to have a bigger presence. They want to operate in a bigger market. Smaller segments have less competition, but of course the overall profitability potential of the segment may be reduced. So there is a trade-off. There may be less competition in the smaller segment, but also less profits. Bigger segment, there may be more profits if the company is successful and has successful strategies to outdo the other companies working in that segment. But that is the trade-off, smaller or larger. So it's necessary to assess the market segments in terms of objectives, capabilities, resources, the mission, the vision. In other words, strategy needs to be worked out here. There needs to be a clear strategy to address the requirements of the segment and to be able to operate within the segment, to be successful competitively and to make a profit. It's necessary to assess the extent to which the market segment complements the company's existing strategies. The company may be operating in a different area or in a different country. The segments that are selected should be complementary so as to minimize on retooling, for example, to alter the product significantly. There may be some alterations required to meet local requirements. But if these are significant, then in effect the company is talking about introducing an entirely new product, that can be very expensive. And the capital cost of doing it may be prohibitive. So the company should be looking towards past growth, innovation, profitability, reputation. And that's what it's aiming to perhaps achieve. Profitability, an extension of its reputation, branding. By giving it a new market, it may be able to innovate the product to suit the new market. Those innovations may have spin-off benefits to yet other markets and other segments elsewhere in the future. So there are benefits from engaging in segmentation and in supplying a particular segment. But there are also downsides in terms of the capital cost. The market entry may be expensive. The marketing requirements to get a foothold in the market may be significant. So really the company has tried to build on its past experience and its past achievements to extend itself into a different segment. And of course that is the way to achieve growth, if possible, by going to other areas, other segments, other parts of the market, trying to extend its range. Some questions to be asked. Well, can the company offer value to the customer in that segment? If it can, then it may be successful. But if this segment is already highly competitive, where is the niche within the segment? And why should customers buy that product? Is the company's image suitable for the segment? Does the image of the company reflect the requirements of that segment? If it's a very high-class retailer, high-class producer of quality goods, expensive quality goods, then perhaps placing it in a depressed area would not make sense. And does the company own sufficient capital resources for investment to enter the segment? It may be that a niche is spotted within a particular segment, but the company does not have the resources necessary to expand production, to engage in marketing and distribution, set up outlets and distribution channels within that segment. So simply identifying a segment does not mean it will be exploited. And really, all of this overlaps with strategy. And strategy takes into account available resources, finances, and borrowings, and the skills of the labour force, the existing capacity of the plant, the ability of the business to expand at minimal cost, minimal impact. In a sense, it's also quite experimental. It may be that it's launched in the segment and fails. So it's successful in one segment and may fail in a different segment. And that's quite possible. So there are risks involved in the whole exercise of entering a different segment, trying to exploit the segment and produce profit as a result of the activities within the segment. As I said, it's a short session, so that's really all I wanted to say about the downsides and the pitfalls, perhaps, in entering a segment, and some of the considerations that need to be taken into account when considering marketing segmentation. And that's all I want to do for this session, so thank you for watching.